Hi, this is Tony McLaughlin. I'm talking payments with Christer Holloman from Divido. Hi, Christer. Thanks very much for joining us.
Thanks for having me.
Hi, Christer. Tell us a little bit about yourself and your company, Divido.
Sure. So Divido is a white label platform for retail finance. So we license our technology to retailers and lenders and payment intermediaries that either want to improve their current retail finance offer or launch it for the first time. So this includes buy now, pay later. This includes interest-free credit and so on. And we've been doing this for 5 years and we're live with 1,000 clients in 10 countries at the moment.
Wow. So, Christer, you're riding this wave, which has kind of come to the forefront in the last, I guess 5 years or so, which is the rise of, buy now, pay later schemes. We've seen mass take up in places like Australia and big players in Europe and the US. So are you a lender yourself? Is that how you do it?
No, so Divido is a technology company. We're an enterprise SaaS platform effectively, and we have created the end-to-end loan origination and loan management solution. And we then license this, we white label this to those that want to offer it or enable it for their consumers or the end consumers. So this could be the retailer, could be the lender, or it could be a payment intermediary.
So, I mean, traditional store credit has been around for a long time. Car finance, department stores offering credit. That's been around for decades. Why has point of sale lending become such a hot topic in the last 3 to 5 years?
Well, I think it's largely driven by consumer preferences. I think consumers obviously throughout the decades have evolved what they want, how they want it. They see something over here and they want the same wherever else they happen to be going. So I think it's been driven by consumers discovering this and having had a taste of this new breed of instant access to credit for a specific amount for a set period of time with very clear and transparent payment terms. They want more of that effectively. So they're saying that to the retailers, and retailers obviously have to respond. So they are shopping around for providers or solutions to enable this facility. And retailers themselves have also had to change clearly a lot. I mean, the move to e-commerce, and I think that a lot of the traditional incumbents in this space haven't really been moving as quickly as the consumers nor the retailers.
Okay, so it's kind of like store credit meets e-commerce turns into point of sale or point of purchase finance, right? It's an old form of lending through a new channel.
Yeah, no, absolutely. And also it's way more cost effective compared to the overhead and infrastructure of, for example, issuing store branded card and the logistics of sending that out and so on. This is obviously kind of more on the spot provision of credit.
I mean, another way I usually kind of refer to this as transactional finance. So it's kind of finance linked to a specific purchase. And the other thing which is remarkable about it is the take up of this form of payment with a younger demographic. So I believe in many markets, it's really it's a millennial demographic and perhaps a smaller basket size or transaction value than through other forms of finance. Is that correct?
Yeah, there's certainly the appeal among the younger consumer to access this kind of credit for their day-to-day purchases, whether it's clothes or something else. But really the inherent appeal to deferring cost or spreading the cost isn't exclusively limited to the minds of a young person.
Yeah.
Clearly, if you're a middle-aged person or even older, given the choice of having to spend £1,000 or $1,000 today, here and now, empty your bank account or max out your credit card versus applying for a line of credit, which gives you the ability to manage your budget over a longer period, if it's interest-free, I mean, it's a no-brainer regardless of your age, really.
Yeah, that's an interesting characteristic of this form of credit. It's often zero cost to the consumer, and so I presume that means that the merchant essentially is funding the cost of finance almost as part of their marketing budget.
Yeah, no, absolutely. I mean, retailers have always had like a toolkit of marketing and sales channels or sales tools at their disposal, whether it's advertising, whether it's opening a flagship store on a busy high street. this is just one more tool in their toolkit. And obviously the retail trading conditions have been under a lot of pressure for a long time. But now, given the global circumstances, they are more interested or more open than they've ever been before to make sure that they've tried all the tools in that toolkit and deployed all those tools and optimized the use of those tools to achieve their objective, which is ultimately to serve consumers and attract consumers back and help them spend and manage their costs. Yeah. And
you're right, just reflecting back on your comment about the types of products that this applies to. It's not just, I mean, fashion has been one of the drivers in some of the markets, especially in the markets where the consumer behavior is to buy 10 items and then send 5 back. And this enables them only to actually part cash with you don't have to actually physically buy the 10 items and part cash for the 10 items. I think that's been one of the drivers, right, is in the millennial segment. But also if I think of, mobile phones these days, mobile phone providers need to provide affordability solutions. And sometimes that's done through contract financing. Sometimes that's done through your form of financing, right?
Yeah, no, absolutely. In fact, the average transaction that we see through our platform is upwards towards $1,000.
Yeah.
So we're seeing that as the consumers might have started doing this for fashion, there is certainly now a greater proliferation across industries and verticals. I mean, for example, consumer electronics, home appliances, furniture, and so on. So it's diversifying in its sort of nature, I think, as well.
So I'd like to kind of look at this in a broader context in terms of this ongoing slugfest between fintechs and banks and big techs. Because it seems that in China, for example, this form of finance is provided within the platforms. So you can see that this form of finance is provided by the big techs in China. And then if we look at the well-known names in Australia, Europe, and the US, those are fintechs. Not much bank participation in this market so far. Is that correct to say?
Well, I think if you think about retail finance in the traditional sense, it's largely dominated by the incumbent banks. If you look at, for example, United Kingdom, you have players like Barclays Partner Finance, you have players like Hitachi Capital or Icano. And between them, they do several billion of pounds worth of financing, which is a lot more than some of the new challengers like PayPal Credit or Klarna and so on. So I think they're targeting at the moment different areas of the market, but these fintechs are not stopping at fashion. They're not stopping at low value. They want it all. And this is, I think, with interesting challenges for banks, that they need to bridge the gap between their tech stack and their customer experience to that of the challenger if they want to defend and grow the pie that they already own. So yes, I think that's the big challenge for the incumbent banks.
And also, I guess, the ability for banks to do instant lending, because you really have to, you're meeting a new customer online, potentially someone you haven't had a relationship with before, and you need to make an instant credit decision. So is that something that the banks are well set up to deliver against?
So it's interesting. I guess it depends on the bank's risk appetite and kind of like inertia and their willingness to build in-house or how open they are to partner with third parties. But I think there is an increasing degree of acceptance to partner with agile third parties such as Divido to go to market quicker, to basically emulate the look and feel of some of these fintech challenges without having to solve every problem or every issue themselves in-house. So again, Divido is that end-to-end sort of solution which enabled them to do instant positioning.
So if you had to give us your observations about the different types of players, the big techs providing this themselves, fintechs challenging the banks, and banks actually being able to deliver this form of finance, how do you see it playing out? Is it too early to say, or do you see the natural advantages of big techs? There was a recent report from the BIS that said that big techs have got an informational advantage when it comes to making these instant lending decisions. Who do you think is going to be a winner between those three different players?
Well, I think the big techs, the challenge there is that they're a tech company, that they're not a bank. They don't have the history or the experience or the kind of benefit of well, maybe 100 years of trading, which would be the case for maybe some of the big established incumbent banks. I think it feels a bit random that a tech company is also a credible bank. So I think that could be a challenge for them going forward. The fintechs, clearly, they have helped create a brand new market, create customer demand, educate retailers, and they've been obviously very successful. And I think that the incumbent banks have allowed them to do that because they haven't yet been infringing on the incumbent banks' business. But the fintechs have come to such a size now that the banks cannot ignore it. Every dollar that a firm is lending is one more dollar in traditional American bank isn't lending to a consumer. So banks now really have the chance to step up. And the benefit the banks have is low cost of capital. They have the brand awareness, the trust and the credibility. And the other benefit the retail banks have is that they have, in most cases, a lot of cases, merchant relationships, maybe cultivated over decades. And that is hard for fintech to compete with. So I think the incumbents will win in the long run.
In the long run, okay. So I guess the whole market is growing, and as a result of the crisis, more and more retailers will be going online, and they will want to provide affordability solutions. So there's probably quite a lot of space for the market to grow. I believe this is the fastest form of or fastest growing form of finance in the US at the moment. And what you're doing essentially is you have a multi-merchant, multi-lender platform that you're delivering directly to merchants in some cases and through banks in other cases. Is that a good understanding?
Yeah, absolutely. So we have three kinds of customers. The retailers can approach us and they can use our platform to connect one or multiple lender in one country or in multiple countries through one global API. So it's very convenient for them to manage multiple lenders. And especially in times like this, we are seeing that lenders are tightening up their lending criteria, which means that more customers will be declined when applying, which is obviously frustrating for the retailer. The only way the retailers can ensure that more customers get access to credit is by having more than one lender. So that, for example, you have a prime lender, a near prime lender, and between them, they can accept more than anyone individually would be able to do. So that's sort of the use case for the retailer. And similarly, because we built this end-to-end system that's white labeled, it's also licensed by banks that want to put their own logo on it and give it to their own retailers.
Well, Christer, thanks very much for giving us a whirlwind tour of the fast-growing point-of-sale finance space or transactional finance space. I've just got a final question for you, which is, I can see what looks like a exercise bike behind you. In this strange world of lockdown, if we ever emerge from it and get back to normal, what from your current way of life would you like to take into the new normal?
I think it's going to have to be me time. So I'm doing my first ever Ironman at the end of the year, and I was sort of planning it out at the start of this year, and I was thinking, how do I squeeze in so many hours on that bicycle and out on the roads running and swimming, and although swimming has been suspended temporarily, this lockdown has really given me the chance to break in my new bike. So yeah, eating more healthy, I'm sleeping better. I even got this new watch that measures stress levels, and my stress levels have come down month on month the last 3 months. So I'm thinking, this is great. So yeah, definitely carving out that me time, I think it's been beneficial for myself.
Well, I guess the crisis has changed all of our perceptions of time and what we do with it.
Indeed.
This has been 15 minutes well worth spent with you. Always great to talk to you, Christer, and look forward to seeing you face to face once we emerge from the lockdown.
Sounds good. Look forward to that too.
Thanks, Christer. Bye-bye.
See you. Bye-bye.